Hi everyone, welcome to this video recording which introduces you to credit risk management. My name is Shailendra Murate. So what exactly is credit risk? What exactly is risk in the first place? The reward and risk relationship, and we'll also talk about the 5 C's of managing the credit risk. So let's begin. A risk is basically uncertainty, something that we don't know what kind of a outcome to expect. In finance terms, risk is the chance that an investment or a portfolio's actual return could be different from the return that we expected. If the return is, of course, on the higher side, we are okay with that. We won't say that it has turned out to be risky. If the return is on the lower side, we'll obviously feel that, we didn't get what we wanted. For example, it could be a portfolio of bonds, a portfolio of equity, or it could be a portfolio of, let's say, home loan borrowers. Now, there are different types of risk. Fundamentally, when it comes to banking, the biggest risk that the banks carry is credit risk, because banks are in the business of giving loans or credit to their borrowers, customers. All banking products primarily focus on taking some kind of a risk on the capability of the borrower to fulfill their obligations, be it bank guarantee, letter of credit, which are examples of non-fund based products, or be it term loan or working capital loan like bank overdraft. There are other risks also, which are like market risk. For example, the fluctuations in the market in terms of the interest rate, commodity prices, they also impact the bank and the bank's borrowers. Foreign exchange or the currency risk is one of the fundamental risks. For example, companies that import oil from abroad, companies that provide their services to customers abroad, they are subjected to foreign exchange risk. Volatility risk, right? The market volatility. How much is the likely fluctuation in the market at a particular point in time is a risk that everybody faces. There's also a sectoral or industry risk. Some of the industries face a specific type of risk. For example, chemicals, they face the risk of environmental damage, right? Any or maybe energy products also. The traditional energy products like coal, petroleum, there's a big risk of any kind of environmental fallout. Liquidity risk is basically risk that you will not have adequate cash to meet your obligations when the time comes. And then there is a monetary risk, inflation risk, etc. So monetary is basically about, for example, a central bank is not able to manage, let's say, inflation rate in the economy or the money supply in the economy. That's a risk that is going to impact all the banks and other players also in the market. There is a way of remedying or tackling this risk to some extent, of course. If the markets turn extremely volatile, I think most of the risk management measures will go haywire. But still, certain financial instruments can be used to manage this risk better, and these are typically called hedging products or risk management products. So what is the risk management function? I spoke to you can use hedging products to manage the risk. It's basically a process where you identify the risk, right? First is we should be aware what kind of risk we are taking when we are doing a particular business transaction. Analyze the risk, what is the potential risk, what are the potential causes, what could be the impact of that risk, what is the probability of that risk happening, etc. And then they accept the risk, because in some business transactions, in some activities, you have to accept the risk. When you are, let's say, traveling by a motorbike, right, you may meet with an accident. You can try to travel or take maximum precaution. That's all you can do, but certain degree of risk exists and we accept that as a risk. Same way, in the financial markets or in any business, you have to accept certain risk that this will occur. Or maybe, and you leave it to chance. For example, you try to take the risk in the best possible way, or if there are any mitigation measures that are possible, then you take those measures. It could be, for example, insuring your property, right? So risk of fire or earthquake is there, you insure your property. So there is a way of mitigating. You can definitely try to mitigate the risk. In investment parlance also, maybe you can buy sort of options, futures products, right? And you can try to mitigate the risk that is involved in the investment decision making or in the execution process. Risk management is also practice of protecting or enhancing the economic value of the firm, right? So basically, the businesses exist for maximizing the economic value or maximizing the wealth of the stakeholders, right? So you can use certain instruments to manage the risk so that the economic value of the firm goes up. It's also a process of evaluating and managing current and possible financial risk of the firm. So risk can be divided into financial and non-financial. Non-financial risks are typically industry risks, or they are, for example, operational risk, like for example risk of earthquake, fire, embezzlement, fraud. Right, these are non-financial risks and which are in the nature of operational risk. Or it could be financial risk, like liquidity risk, for example. Right, credit risk is the financial risk. So the fundamental purpose of a risk manager's job is to identify the risk, evaluate possible remedies. What can we do to tackle those risks, to mitigate or protect from those risks, and then implement the steps necessary to tackle those risks. That is fundamentally the purpose of the job of a risk manager. However, one thing we have to understand that fundamentally in the nature there is a risk or return trade-off, right? So by nature, most of the investment opportunities that we will get, if the risk is low, typically the return is also low. Conversely, when you expect a higher level of return, you may be required to take a higher level of risk. Now, this is not something which is like absolutely written in black and white. There are opportunities which are somewhere in the middle, right? But this is broadly how the nature works. The reason for this is, if there are opportunities where the risk is low but return is very high, everybody will rush to grab those opportunities, correct? That's why those opportunities are by nature few in numbers. And if there is a high risk opportunity which gives very low rate of return, people will not go for those kind of opportunities. And that's why they also are not practical, and you can say don't that much exist in nature. If it's a high risk venture, higher return potential has to be there. Otherwise, people will not normally venture into those kind of areas. In finance, standard deviation is taken as one of the fundamental measures of risk, right? Because standard deviation helps you calculate how much the returns may be moving away from the mean or the average, and it indicates certain degree of volatility. So this is a representation where returns are on one of the axes and standard deviation is on the other axis. Graphically representing how the risk and return trade-off has to be done in the financial markets. So as a person in finance, you have to be aware that this is the fundamental trade-off that exists. It's a principle that potential risk rises with an return rises with the increasing risk. It's a potential return. You may still not get the return, right? So just by being a high risk, taking a high risk kind of approach, that doesn't guarantee that you will get more return, right? It's just a possibility of getting a higher return. Asset classes can also be broadly sort of categorized or mapped using this same expected return versus risk sort of the relationship, right? On one hand, we might put, let's say, treasury bills which are issued by the government. They are short-term in nature, right? Government debt is considered to be zero risk in almost all the economies, unless it's a very situation where economy is in big crisis and government also may not repay, right? But in the normal course of business, most of the times in most of the economies that function well, treasury bills are considered to be very low risk, and they also give very low return. Currently, the treasury bills give a relatively high return in India. I think the return has gone up by about 1.5% in 2022 itself, and they are about, I think, for 5.7, 5.8% return you can expect, which is on the higher side, but still it is lower as compared to, let's say, long-term bonds, right, or compared to equities, which have a higher risk and also potential of a higher reward. Savings account, fixed deposits, etc. As you know, their rates are typically very close to treasury bills. So SB accounts, savings accounts, and FDs, they had somewhere between 3.5 to 4.5%, 5% in well-managed banks. That kind of a return around 2021. Now it has gone up in both the cases by approximately 1%. Government bonds, but again, government issues it, but they are long-term in nature, so 1 year plus, right? So their return is typically higher. Risk is also higher because it's a long-term instrument. And then so on. Corporate bonds, maybe AAA rated corporate bonds have very low risk, but AA rated, etc., have higher level of risk. Mutual funds by nature slightly higher level of risk because they invest in a portfolio, right? So portfolio of bonds, portfolio of equities, or a balanced portfolio, etc. Stocks, real estate, so on and so forth, right? So it is not that at any given point in time they all exist in exactly the same order, right? For example, real estate returns may look like low risk returns and low and low returns also at some point in time, right? It is possible. So it's not like it's a very sacrosanct, carved in stone kind of a depiction, but generally it gives you a sense of how if you want to take a higher risk, then only you can expect a higher reward in the market. All the portfolio managers, etc., want to look for bargains that will give them high expected return while taking lower level of risk. That's exactly what everybody tries to do in the market. Now, having been introduced fundamentally to the concept of risk and return relationship, let's talk about credit risk. Credit risk is, as I said, one of the biggest risks, specifically in banking, but also other players, for example, who take, let's say, invest in bonds, right? So insurance companies invest in bonds, mutual funds invest in bonds, right? So all of them are carrying credit risk. Even hedge funds, for example, they invest in junk bonds, etc. So they carry a credit risk. There are fundamentally two sources of credit risk. Why would credit risk occur, or why a default would occur? It's also called a default risk, right? Somebody not being able to meet their obligation, not being able to pay, let's say, interest, or not being able to repay the amount on redemption. Let's say a borrower not being able to pay back term loan, as an example. So these two fundamental sources are bifurcated into systematic risk and unsystematic risk, right? As the nature suggests, systematic risk is in the entire system. For example, Indian financial system. Non-systematic risk or unsystematic risk is very specific to, let's say, a business or a specific, industry, right? So it's a very, that's why it is called unsystematic. It is not for the entire system, but it is specific to industry or a business. Now, what are the different systematic risks that exist in the entire system? Socio-political risk, right? Any kind of social unrest, for example, how the society is functioning. Is it peaceful? How is the political environment, right? So is there a political instability? For example, frequent changes in governments, in leadership, right? That is a big risk that the businesses face, because there's a reason why these things are happening, right? So, and then that has consequences on how the country's economy is managed, how the central banks manage the money supply, inflation, etc., and how the government and sort of business relationship works. So it is also a risk. Economic risks are, for example, a country not performing well economically. Maybe social political, there is a relative stability, but still economy is not performing well for various factors, right? So the productivity is less, right? There's lack of availability of skilled human resources. There will be lack of productivity of access to resources like commodities, for example, lack of power generation, right? So many factors will be there, and then this gives rise to something called economic risk. So there is no jobs creation, there is no increase in the the overall GDP, right? So these are basically the economic risks. And then this could also be, for example, very high level of inflation or high level of interest rates. High level of interest rates means the businesses don't get funds cheaply, so they have to borrow at a very high level of interest. So which means their cost of production goes up, right? Because one of the raw materials required for business is money, and the cost of money is interest, right? So high level of interest rates also are economic risk. And there could be other exogenous or external risk, for example, like they could be, for example, outside your economy also. So wars happening, for example, terrorism events, other economies not performing well, the shocks in the other financial markets. For example, global financial crisis of 2008, right? Another exogenous or outside risk which impacted Indian market also. Russia-Ukraine war, for example, has impacted commodity prices and energy prices across the world, and it has increased inflation in India also, right? So these are other exogenous risks. So all these are basically all businesses, all financial players in the economy. None of them, are able to escape from this risk. It's only that some of them are able to manage it better. Maybe some of them are relatively less impacted, some are more impacted, but everybody is impacted by the systematic risk because it pervades across the entire system. Examples could be, again, when the inflation rises or interest rate rises, companies that are heavily borrowing, right? So they may not be able to pay back their borrowings to the banks. So banks are impacted by this kind of a systematic risk. Unsystematic risk, as I mentioned, are not system-wide. They could be specific to the industry. For example, recently the ESMA, that is the European Securities Market Association, which is a part of the European Union, one of the regulators, they banned the 7 clearing organizations in India, right? So they de-recognize them or disqualified them, saying, the European bank cannot, put deals to them or cannot settle to them, right? The impact is on the European banks which are functioning in India. Now, that is a very specific risk for the banking organizations, but other European organizations working in India are not directly impacted, right? So it's a very industry-specific risk. Other could be, for example, we saw that there have been a lot of protests against nuclear power plants across the world, right? So over last about 2 or 3 decades, which is a very specific risk, faced by a particular portion of the energy markets, right? It's not system-wide directly, of course. Lack of energy will impact everybody, lack of energy production, but that is a direct, industry risk. That's one type. The other business risk also, which are, for example, a particular business as, let's say, dependent on the availability of large skilled, workforce, right? So if that workforce is not available, that particular industry is impacted. Maybe those which are not dependent on skilled workforce to that extent, they may not be impacted. And then there are financial risks. Fundamentally, credit risk is also one of the financial risks, but the other risk like liquidity risk, the overall long-term stability risk of an organization, right? So those are examples of other financial risks. So all these can impact the credit risk, and these are fundamentally the sources of why the defaults might happen, or why the people who borrow money or who raise money through bonds, etc., may not be able to pay back. Now, what are the different ways you can do the credit risk analysis in order to make sure that you are dealing with parties where the credit risk is as low as possible? Of course, you have to keep one thing in mind. If you go for parties which are very, very low risk, they may not give you a high return because everybody will be after those parties, right? So a AAA borrower, a company which is being fundamentally outstanding, is in good industry, right? Good profitability, good track record. That company will not borrow from you at a very high rate, right? You want a borrower who's willing to pay you a higher rate of interest, you have to go for slightly higher risky borrower. But given that, we'll have to first assess what is the risk involved in a particular borrower. And these are fundamental. There's a model, 5Cs model, which I think continues and will continue to be prevalent, right? Some people can break it down into, let's say, 7Cs, 7Ds, or something like that. But still, fundamentally, these are the 5 key elements which bank or any player who's taking the risk, they look at when they are just sort of analyzing the credit risk. When, let's say, a bank is approached by a borrower, for example, there is a borrower, there's a project coming up for, let's say, setting up a pharmaceutical plant, right? Let's take that example. Let's say a 200 crore project in pharma bulk drugs. In pharma, we broadly have bulk drugs, which is generics, and then we have generics and we have specific sort of formulation product. Now, let's say then the bank will look at the character of the promoters, the people who are running the company, like their board of directors, the founders, key investors in that particular organization, who could be, for example, even a private equity fund, for example, right? So they will look at those people. They will look at what is their performance in the past. Have any of them worked with companies which have defaulted in making their payments? Right? Do any of them have any kind of sort of the law cases against them? Right? So that fundamentally represents the character or integrity of the management. Apart from that, they will also look at the character or track record of the company itself. Right? If the company has been in existence for, let's say, a few years, then they will look at what is their past history. How are they managing their finances? They'll scrutinize their balance sheet. They'll go through that and look at, have they taken in loans in the past, right? How have they raised the money, right? Have they given adequate returns to all the stakeholders? They will go through their balance sheet literally, with a sort of comb, and they'll find out, are there any law cases pending against the company itself? How is it on the environmental aspects? How is it in dealing with the society? How is it in payment of the taxes to the government? And this basically gives you an idea what is the character of the borrower, right? So how is the borrower example? And this is character is supposed to be one of the most important elements that you should thoroughly consider when you are going to potentially give credit to anyone, right? Because even if other things are good, if the character or the integrity is not there, it is likely that you may face a problem in the relationship in future. That's one of the very prevalent points. Next comes is how much is the capital. So in that particular 200 crore project, for example, bulk drug project, how much is the capital that the company is able to raise from other sources? For example, how much is it that the founders or promoters are putting in? How much is that the other investors are putting in? Are they able to raise the capital from the shareholders, right? So what is the risk that equity holders are taking? That's why we have this debt equity ratio, etc. Right? So if somebody is putting in 50 crores in that project by way of equity from various sources and expects you to give 150 crores by way of debt, right? Obviously, that is more risky because there's only 50 crores of owners' money in business and 150 crores of banks, different banks maybe, but their money in business, right? So which is highly risky. Compare it to, you know, some company putting in 120 or 130 crores and asking for 70 crores of bank loan. That is obviously relatively less risky, and you will also have, you know, more assets available overall. If you give 80 crores, you have 200 crores of assets available as a collateral, right? So, which is another point that we'll talk in sometime. So, how much is the capital? Do they have the capacity? Do they have the reputation to raise more capital in case required? Right. So, that is something that you want to very carefully consider. Collateral. How much is the collateral that the borrower is able to offer you by? So, collateral is basically security. You know, what are they giving us? For example, in home loan, home is a collateral, right? So, bank has a charge noted with the registrar against that particular home. When the car loan is given, for example, on the RC book, the leasing company or the company which is giving the loan, it, you know, records on that RC book saying that, you know, this is hypothecated to such and such company or such and such bank. So collateral is always important. What is the quality of collateral? What kind of collateral it is? How easily can it be liquidated or sold? Right. For example, treasury bonds, very good collateral. That's why we have repo as repurchase as one of the most popular, you know, products in the money markets. Also, what is the cost of liquidating the collateral? For example, real estate, you know, selling costs are very high. These are stamp duties or transaction costs are very high. So that may not be considered as a very good collateral, but still banks demand it because, you know, generally in India, though there have been fluctuations in real estate prices, they have not been as high as possibly, you know, when in the 2008 kind of situation in US. The real estate as a collateral is still, you know, perceived to be better in India. But liquidating real estate is not easy, right? Every house is different, and, you know, selling it off is not that easy. And as I said, the transaction costs are very high. So, what kind of collateral, how much collateral the borrower is able to give is extremely important. If borrower is, let's say, giving you 2 times the collateral, which is highly liquid, has a low cost of liquidation, it can be very, you know, sort of prices can be tracked very easily to understand what is the value of the collateral today, then bank would, you know, definitely go for that kind of a loan. One more aspect that matters is what is the capacity of the borrower to pay back, right? See, capital they might have put in adequate, they might have given good collateral, character also might be good, but if the project itself doesn't have the capacity to pay back, let's say now in this pharma project, for example, they are asking for, let's say, 100 crore loan and 100 crore equity they are putting in. If the bank wants to take exposure for 5 years, will the company generate more than 100 crores of cash in those 5 years to pay you back, right? That's the, you know, the fundamentally question that the bank has to ask. And then for that, they will look at the financial projections, they look at the past history, whether the financial projections are reliable, how the projections have been made out, are they realistic, right? And banks will develop their own base case for their own projections. You know, their own estimates they will make based on the projections given by the borrower or their financial consultants, and then they'll prepare their own case. You know, does it look realistic, and what kind of capacity exists with this particular borrower, you know, pay back the loan. So that is always important. You know, that's why when home loan is asked for example, the bank will work out your capacity, saying, you know, for example, your salary is so much of your household expenses, so much of your other obligations, and now so much is left. Let's say 30,000 rupees per month is left. Then based on 30,000 rupees, how much EMI will be able to pay, right? So bank may give you only, let's say, loan which has an EMI up to, let's say, 20 or 25,000 because you don't have the capacity to pay beyond that. And last important factor is, you know, how the bank can design the terms and conditions of the particular loan. And a lot of ways, you know, you can manage the risk by designing particular terms and conditions that work in the bank's favor. For example, can you give a floating rate interest rate loan, right? So one of the risk in any kind of borrowing is the interest rate. Fixed rate, for example, if the interest rate goes down, the borrower still has to pay higher rate of interest, right? So many times for the long-term loans, the borrowings and lending are done on the basis of floating rate, right? So where the rate is benchmarked to some other, you know, independent benchmark in the market. For example, the bonds yield, for example, or something like that, right? So that's how it is done. What kind of other conditions can you put? For example, will the bank be able to inspect the, you know, the physical side of the business, right? Bank, let's say, is giving the working capital loan, for example, like overdraft or cash credit against stocks, right? Now, how frequently the bank can go and inspect whether actually the stock exists? They can visit the customers' go downs and, you know, check that, right? So that is one condition that can be put. Another thing is, as I, you know, said, for example, can you, for example, note a charge on the particular, you know, collateral which is given to you, right? So can that condition be fulfilled? Can you, for example, say you will not declare dividend or you will not do XYZ activities before paying the bank first or taking bank's clearance first, right? So that is also one of the conditions that can be put. All these conditions that will not sort of kill the business. Definitely don't want to kill the borrower's business, but which will put certain reasonable restrictions so the bank's interest is taken care of, right? The lender's interest is taken care of. With those kind of conditions can be put, then the bank will be more happy. So these are fundamentally the 5 C's of credit risk analysis, which are, I think, very, very sort of, you can say the golden rules around which credit risk is evaluated. Of course, some factors may be missing here and there, but you can club by and large at least any of these 5 factors before considering how the credit risk analysis has to be done. So I think these are, if you remember these 5 by and large, you will know most of how credit risk management should be done. So these are explained on the next slide. So I'll of course not spend time here. Here, right? So all these factors are explained over here. So what we cover, right, in this particular video, let me just go back and quickly look at that. So one is we fundamentally look at what is the risk, fundamentally is uncertainty, and you can use various financial instruments to manage the risk. We looked at what is the risk management process, identify the risk, analyze the implications of risk, and either accept it or devise some kind of a mitigation measure. We looked at, for example, conditions or collateral are one of the mitigation measures for managing the risk. And the very natural, relationship between risk and return, and the trade-off that you are forced to do in order to, if you want to pursue higher returns, you may have to accept higher level of potential risk. And how different assets can be, financial assets, etc., can be ranked on the basis of risk return trade-off. When we looked at the sources of credit risk, systematic, that are system-wide risk, for example, that face entire Indian economy, and then we looked at the unsystematic risk, which are industry or business specific, etc. And then 5 C's of how do you analyze the capability of the borrower, or how do you rank the borrowers who approach you, right? And you don't have to just appraise them once. You have to keep doing it maybe at least every 6 months or a year to understand whether the financial situation of the borrower has changed, or the risk in the particular account has increased or decreased, right? So that's what you're doing. So thank you very much for patience listening, and all the best.